Currency has played a significant role in the development of human civilization, and its origins can be traced back to the ancient times. Have you ever wondered how we came to use currency as a means of exchange? Hello and welcome to our channel, Financial Capital Advisory. Now let's dive deeper into the fascinating history of currency. Before the concept of currency existed, people used a barter system to exchange goods and services. This system was prevalent in the ancient societies where people would trade goods such as food, clothing, and tools for other goods or services they required. The barter system had several limitations. One of the significant issues was the inconvenience of carrying goods around for exchange. Traders often had to travel long distances carrying heavy loads of goods with them, which was not only physically exhausting but also dangerous. Moreover, there was no standard value assigned to goods, leading to confusion and disputes. It was during the 7th century BC in Lydia, which is now modern-day Turkey, that the concept of currency emerged. The Lydians were the first civilization to mint coins made of gold and silver, which was stamped with a government symbol to ensure authenticity. These coins were standardized, making them more convenient for trading. The use of coins as a currency spread rapidly across the world, especially along the Silk Road, an ancient trade route that connected Asia and Europe. Different regions began minting their own coins, and soon the concept of paper currency was introduced. Today, we use paper and digital currency as a means of exchange. The value of these currencies is determined by governments and financial institutions based on various economic factors. Modern currencies have evolved from the early days of coins to paper currency and now to digital currency, which allows for more convenient and faster transactions. However, the history of currency is not just about its evolution but also its impact on human societies. The use of currency has enabled trade, commerce, and the growth of economies, which has played a significant role in shaping the world we live in today. The development of currency was crucial in the expansion of trade and commerce. Before the advent of currency, trade was limited to local communities and it was challenging to conduct transactions with people outside the community. The introduction of currency allowed traders to conduct transactions with people from different regions, which enabled the growth of commerce and trade on a much larger scale. Currency also enabled the growth of economies by providing a means of storing value. Before the advent of currency, people stored their wealth in the form of commodities, such as food or livestock. However, these commodities were perishable, and their value was subject to fluctuations based on the availability of the commodity in the market. The introduction of currency provided a stable means of storing value, which enabled people to accumulate wealth and invest in the growth of their economies. The evolution of currency has resulted in the creation of complex financial systems such as the stock market, which allows people to buy and sell shares of companies. The stock market is a critical part of the global economy, and its impact on society cannot be understated. It enables companies to raise capital to fund their operations, which in turn creates job opportunities and drives economic growth. The stock market is not the only example of a complex financial system that has developed as a result of the evolution of currency. Other examples include the bond market, futures market, and the foreign exchange market. These markets enable investors to trade financial instruments that derive their value from underlying assets such as stocks, bonds, or commodities. However, the evolution of currency and financial systems has not been without its challenges. The use of currency has also led to several issues such as inflation, currency manipulation, and financial crisis. Inflation is the devaluation of currency over time, which results in a decrease in the purchasing power of that currency. This can occur due to various reasons, such as an increase in the money supply, which leads to a decrease in the value of currency. Governments and central banks must manage inflation to ensure that it remains within a certain range to prevent the economy from suffering. Currency manipulation occurs when governments intentionally devalue their currencies to gain a competitive advantage in the global market. This can lead to a currency war where countries try to outdo each other by devaluing their currencies, which can lead to significant economic instability. Financial crises have also occurred due to the misuse and abuse of financial systems. The most recent financial crisis occurred in 2008, where the collapse of the housing market in the United States triggered a global economic recession. The crisis was caused by the reckless lending practice of banks, which resulted in high number of foreclosures and a sharp decline in housing prices. The introduction of digital currency has opened up a new era in the history of currency. Digital currency is a form of currency that is entirely digital and operates on a decentralized system called the blockchain. Digital currency offers several advantages over traditional currency, such as faster transaction, lower transaction fees, and enhanced security. One of the most well-known digital currencies is Bitcoin, which was created in 2009. Bitcoin is a decentralized currency, which means that it operates independently of governments and financial institutions. The value of Bitcoin is determined by supply and demand, and it is subject to fluctuations similar to traditional currencies. The use of digital currency has gained popularity in recent years, with several other digital currencies such as Ethereum and Litecoin entering the market. However, the use of digital currency is not without its challenges, such as regulatory issues and the potential for fraud and hacking. The evolution of currency has resulted in the creation of a vast and complex financial system, which has played a significant role in shaping the world we live in today. However, this system is not without its flaws, and it is up to governments and financial institutions to manage and regulate it to ensure its stability. Currency has come a long way since the days of bartering and trading goods. It has played a significant role in enabling trade, commerce, and the growth of economies. Its evolution has also resulted in the creation of complex financial systems, which have led to the development of new industries and job opportunities. The history of currency is a fascinating subject, and it continues to evolve with the introduction of digital currency. Whether it's digital or traditional, currency remains an essential aspect of our daily lives, and its impact on society cannot be understated. As we look to the future, it's clear that the role of currency and financial systems will continue to evolve. We are already seeing the rise of new technologies such as blockchain and artificial intelligence, which have the potential to revolutionize the way we transact and manage our finances. One of the most promising areas of development is the use of blockchain technology in financial systems. Blockchain is a decentralized ledger that allows for secure and transparent transactions without the need of intermediaries. This has the potential to reduce transaction costs, increase efficiency, and prevent fraud. Another area of development is the use of artificial intelligence in financial systems. AI has the potential to automate many financial tasks such as fraud detection and risk management, which can lead to more accurate and efficient financial management. We are also seeing a significant shift towards mobile and cashless payment systems, which have the potential to make transactions faster, more convenient, and more secure. Mobile payment apps such as Apple Pay and Google Wallet allows users to make payments using their smartphones, which has become increasingly popular in recent years. Cashless payment systems have also gained popularity, with many countries such as Sweden and China moving towards becoming cashless society. This has the potential to reduce crime, increase financial transparency, and improve efficiency in financial transactions. Credit and debit cards have also revolutionized the way we make transactions. They allow us to make purchases without carrying cash, and they offer several benefits such as reward programs and fraud protection. However, credit card debt has become a significant issue in many countries, and it's important for individuals to manage their credit responsibly. Automated teller machines, ATMs, have also become a ubiquitous part of our financial landscape. They allow us to withdraw cash and make deposits, and they are available 24 hours a day, 7 days a week. However, ATMs have also become a target for fraud, and it's important for individuals to take necessary precautions to protect their financial information. The rise of the internet and mobile devices has also led to a significant increase in online trading and investing. Online trading platforms and apps allow individuals to buy and sell stocks and other securities from the comfort of their own homes. However, online trading carries risks, and it's important for individuals to educate themselves and make informed investment decisions. Finally, financial advice and planning have become more important than ever with the increasing complexity of financial systems. It's essential to have a solid understanding of personal finance and to have access to qualified professionals who can provide advice and guidance. Whether it's planning for retirement, investing in stocks, or managing debt, seeking professional financial advice can make a significant difference in achieving financial goals. In conclusion, the history of currency is a fascinating subject, and its evolution has played a significant role in shaping the world we live in today. As we move towards a more digital and cashless society, it's essential to understand the changing landscape of a financial system and to take necessary precautions to protect our financial information. By staying informed and educated, we can make informed decisions and take advantage of the benefits that the evolution of currency has to offer. Thank you for joining us on this journey through the history and evolution of currency. We hope you found this video informative and engaging. As we have seen, currency has played a crucial role in the development of human civilization, and its evolution has been shaped by numerous factors, including economic, political, and technological advancements. From the earliest forms of barter and trade to the complex financial systems of today, currency has undergone significant changes over the centuries. With the rise of new technologies such as blockchain and AI and the growing popularity of mobile and cashless payment systems, it's clear that the future of currency is in a state of constant evolution. It's important for individuals to stay informed and educated about these changes as they can have a significant impact on personal finances and the global economy as a whole. So what's next for the world of currency? Only time will tell. But one thing is certain, currency will continue to evolve and adapt to meet the needs of society. As we navigate this changing landscape, it's important to remember the lessons of history and to embrace the possibilities of the future.
Gold has been considered a symbol of wealth and power throughout history. Ancient civilization used gold for many purposes, including decoration, jewelry, and currency. In ancient Egypt, gold was used to decorate tombs and temples, and it was also used as a currency for trading. The Greeks and Romans also used gold as a currency and for jewelry, and during the Middle Ages, gold coins were widely used as a currency in Europe. During the gold rush of the 19th century, gold was discovered in large quantities in California, which led to a boom in gold mining. This led to the creation of new gold currencies, and the United States adopted the gold standard in 1900, which meant that the value of the dollar was tied to the price of gold. However, in 1971, the United States ended the gold standard, which meant that the value of currency was no longer tied to the value of gold. Despite this, gold remains a valuable asset and it is still widely traded. Benefits of investing in gold. One of the primary benefits of investing in gold is its low correlation to other assets. This means that gold doesn't move in the same direction as other investments such as stocks and bonds. As a result, gold can be a valuable diversification tool for investors who are looking to reduce their portfolio's risk. Another benefit of investing in gold is its safe haven status. This means that it tends to increase in value during times of economic uncertainty. During times of inflation or currency devaluation, gold can act as a hedge against these risks. Gold is also a finite resource, which means that its supply is limited. As demand for gold increases, its value can also increase. This makes gold a valuable asset to own as part of a long-term investment strategy. There are several ways to invest in gold, including physical gold, gold ETFs, and gold mining stocks. Physical gold can be purchased in the form of coins or bars, but this can be costly and requires storage. Gold ETFs are an easier and more cost-effective way to invest in gold, as they are traded on stock exchanges and offer exposure to the price of gold. Gold mining stocks offer exposure to the gold mining industry, but they also come with additional risks such as operational and financial risks. Investors should consider investment goals, risk tolerance, and investment time horizon when deciding which type of gold investment is right for them. While gold can be a valuable investment, it also comes with risks. One of the primary risks of investing in gold is its volatility. The price of gold can fluctuate rapidly, which can lead to significant losses for investors who are not prepared for this volatility. Investing in gold can also be expensive, especially when it comes to physical gold. Storage and insurance costs can add up over time, which can eat into returns. Additionally, gold does not generate any income, which means that investors cannot rely on dividends or interest payments to generate returns. Investors should also be aware of the risks associated with gold mining stocks, such as operational and financial risks. Gold mining stocks can be volatile and they can be affected by factors such as geopolitical events, labor disputes, and natural disasters. The price of gold is influenced by various factors, including supply and demand, inflation, economic and geopolitical events, and the value of the US dollar. When the demand for gold exceeds its supply, the price of gold tends to increase and vice versa. Inflation can also influence the price of gold, as investors often turn to gold as a hedge against inflation. Economic and geopolitical events, such as changes in interest rates or political instability, can also affect the price of gold. Finally, the value of the US dollar can have a significant impact on the price of gold. When the US dollar weakens, the price of gold tends to increase as investors turn to gold as a hedge against currency devaluation. Investors should consider investing in gold as a part of diversified investment portfolio. The exact timing of when to invest in gold will depend on a variety of factors, including the investor's risk tolerance, investment goals, and the investment time horizon. Investors who are looking to use gold as a hedge against economic uncertainty may want to consider investing in gold when they expect economic conditions to deteriorate. This could include times of high inflation, currency devaluation, or geopolitical instability. Investors who are looking to use gold as long-term investment may want to consider investing in gold on a regular basis, such as through a gold ETF or by purchasing physical gold on a regular basis. This can help to smooth out the volatility of the price of gold over time. Investors should also consider the tax implications of investing in gold. The tax treatment of gold investments can vary depending on the type of investment and the investor's country of residence. In the United States, for example, physical gold investments are subject to capital gains taxes when sold for a profit. Gold ETFs, on the other hand, are treated as stocks and are subject to capital gains taxes when sold for a profit. Investors should consult with a tax professional to understand the tax implications of investing in gold in their country of residence. Investors should be aware of common mistakes to avoid when investing in gold. One common mistake is investing too heavily in gold, which can lead to an over-concentration of risk in a single asset. Another mistake is investing in gold at the wrong time, such as when the price of gold is high and likely to fall in the short term. Investors should also be aware of the risks associated with gold mining stocks, and they should do their research before investing in these type of stocks. Finally, investors should be aware of scams and fraudulent schemes that target gold investors. These can include fake gold coins or bars, Ponzi schemes, and high-pressure sales tactics. While physical gold is a popular way to invest in gold, there are alternative ways to invest in gold without owning physical gold. These include investing in gold ETFs, gold mining stocks, and gold future contracts. Gold ETFs are a type of exchange-traded fund that tracks the price of gold. They are a convenient way to invest in the gold without the need to own physical gold. Gold ETFs offer investors the ability to buy and sell gold on an exchange, just like a stock. Gold mining stocks are another way to invest in gold. These are stocks of companies that mine gold or their precious metal. These are the stocks of companies that mine gold or other precious metals. The price of these stocks is often correlated with the price of gold, but they can also be affected by other factors such as the company's financial performance and management decisions. Finally, Investors can also invest in gold future contracts. These are contracts that allow investors to buy or sell gold at a future date and price. Gold future contracts can be used to speculate on the price of gold or to hedge against price changes. How much to invest in gold? The amount of money investors should allocate to gold depends on the investment goals and risk tolerance. As a general rule, investors should not invest more than 5 to 10% of their investment portfolio in gold. Investors who are looking to use gold as a hedge against economic uncertainty may want to consider investing a higher percentage of their portfolio in gold. However, they should be aware of the risks associated with investing too heavily in a single asset. Investors who are interested in buying physical gold can do so through a variety of channels, including bullion dealers, online retailers, and banks. When buying physical gold, investors should be aware of the purity of the gold they are purchasing, as well as any additional fees or charges associated with the purchase. Investors should also consider the storage and insurance cost associated with owning physical gold. While selling physical gold, investors can do so through a variety of channels, including bullion dealers, pawn shops, and online retailers. Investors should be aware of the current market price of gold when selling, as well as any fees or charges associated with the sale. Investors should also consider the tax implications of selling gold for a profit. Investors should also be aware of the risks of gold investment scams. These scams often involve promises of high returns or exclusive access to gold reserves, but in reality, they are fraudulent schemes designed to steal money from unsuspecting investors. Investors should be wary of any investment opportunity that seems too good to be true and should thoroughly research any company or individual offering gold investment opportunities before investing any money. Investors should also be aware of the tax implications of investing in gold. Depending on the jurisdiction, gold investment may be subject to capital gains tax or other taxes. It is important for investors to understand the tax law in their jurisdiction and to consult with a tax professional before making any investment decision. Long-term outlook for gold. Despite the risks associated with investment in gold, many analysts believe that gold will continue to hold its value over the long term. Gold has been a store of value for thousands of years, and its limited supply and historical significance suggest that it will continue to hold value in the future. Additionally, global economic uncertainty and geopolitical risks are likely to continue, which could support the demand for gold as a safe haven asset. This could drive the price of gold high over the long term. Investing in gold can be a valuable addition to a well-diversified investment portfolio. It offers a hedge against economic uncertainty, diversification benefits, and a limited supply. However, investors should be aware of the risks and tax implications of investing in gold and avoid common mistakes such as overconcentration, investing at the wrong time, and falling for scams. By doing their research and consulting with a financial advisor, investors can make informed decisions about investing in gold and build a well-diversified investment portfolio that meets their investment goals and risk tolerance. Investing in gold is a popular investment strategy for many investors due to its historical significance, limited supply, and diversification benefits. However, investors should approach gold investments with caution, as there are risks and pitfalls associated with investing in this precious metal. By carefully considering the benefit and risk of investing in gold, researching investment opportunities thoroughly, and consulting with a financial advisor, investors can make informed decisions and build a well-diversified investment portfolio that meets their financial goals and risk tolerance. Ultimately, investing in gold can be a valuable addition to a well-diversified investment portfolio, but it is important to approach it with a clear understanding of its potential risks and benefits, and to make investment decisions based on a thoughtful analysis of one's individual financial situation, and investment goals. If you found this video helpful, be sure to like and subscribe to our channel for more informative videos on personal finance and banking. Don't forget to share this video with your family and friends who may also benefit from this information. Remember to always do your own research and consult with a financial advisor before making any major financial decisions. The best definition of financial literacy comes from the Financial Consumer Agency of Canada. The FCAC is an excellent source of financial literacy information and resources.
They define financial literacy as having the knowledge, skills, and confidence to make responsible financial decisions. They further break the definition down into more detail, where knowledge refers to a person's understanding of financial matters, skills are the ability to apply that knowledge, and confidence is the sense of self assurance you will want when making important decisions. Responsible financial decisions are the product of these three aspects coming together when it's time for you to make choices that will work for you. Financial literacy can help you make smarter, more informed financial decisions, which will allow you to stay on top of your financial obligations. It will help you avoid negative repercussions or penalties, help you prepare for your future, help you navigate what can be complex or confusing financial systems, and allow you to discover helpful resources that can benefit you continuously throughout your life. Budgeting is the main aspect of personal finance for each individual. A budget is a financial tool that allows you to track your income and your expenses in order to determine if you can meet your financial goals or obligations. It's a plan for your money. The process of making a budget can help you set spending limits, find ways to reduce cost and put more money into your savings, and help you live within your means. Continuously tracking your money can help you find areas where you may be overspending or spending unnecessarily. The process of creating a budget can be broken down into 4 easy steps. Step 1. Figure out what you are typically spending on various items. Go back through your banking history for 1 to 2 months. If you aren't sure or if you use cash, you will need to start now and start tracking every dollar you spend. Even small things such as a $2 for a coffee can really add up. So it's very important that you count every dollar spent for a period of time to have an accurate idea of where your money is going. Step 2. Start by listing out your income and expenses. Use your bank statements and your personal tracking to help you. You should set up your budget according to income frequency. If you receive a bi-weekly paycheck, your budget should be bi-weekly. You should set aside equal amounts of your monthly expenses from each paycheck to ensure your budget limit stays consistent each time, and you will be less likely to have to rely on credit to help make ends meet. Think ahead to sporadic events that have financial impacts and try to set aside some money in each pay in preparation. A good budget will have a plan for emergencies or unexpected events. Step 3. Review your results and adjust as needed. Compare your overall totals to see if you have a surplus or a deficit. If you have a surplus on paper but find you're constantly short in practice, look back on your spending history to try to pinpoint where the gaps are coming from. Use any surplus to put towards future financial goals, either short or long term. If you have a deficit, look for areas where you can cut costs or seek out other financial resources to help fill the gaps. Step 4. Revise as needed. A budget is not a one-time activity. You must continually compare where your money is actually going to what your budget plan is and make adjustments if you have strayed from your plan. Your budget will change over time as life circumstances changes. See what categories you tend to overspend in and focus your attention here. Are you constantly overspending on groceries, for example, and as a result not putting aside as much as you would like in savings? Identify any problem areas and use this to do a thorough review of your spending in that category. Ask yourself if every purchase you made was absolutely necessary. It can sometimes be difficult to determine whether a purchase is absolutely necessary. When creating your budget, think of what is absolutely required or essential in life. Typically, these are categories such as housing, clothing, and food, and these are what we call needs. Wants, on the other hand, are not absolutely essential to living, but rather are things you may like for one reason or another. Wants and needs can be different from one person to the next based on circumstances. For example, if someone lives in an area without public transit and they cannot use alternative means of transportation, a car may be a need for that person to travel for work or to purchase necessities to live. Whereas, another person may reside within a city or town and therefore a car is not necessarily required for that person to live and work. Society can sometimes make it difficult to determine what is a need and a want. We are constantly bombarded with advertisements for the latest trends and technologies. It is easy to think that something is a need when advertisers point out features of a product that seemingly will make your life easier or better in some way. Try these tips to avoid spending on wants. Shop from a list of items and buy nothing else. Adding in a chocolate bar or sale items when you don't really need it can add up over time. When you feel the urge to buy an item, make yourself wait 30 days before buying it. Often you'll discover that your interest was just momentary. Be creative. See what items you already have that serve a similar purpose to avoid the need to purchase something else. Be careful of window shopping, both in person and online. It is a good idea to check grocery flyers for sales, but endless browsing on shopping websites or on other flyers will undoubtedly lead you to items you likely don't really need. Try to avoid shopping as a social activity. Find other ways to socialize that won't lead to mindless spending or impulse buying. Let your circumstances determine what you need to seek out. Plan ahead. Carry a reusable water bottle or snacks with you will help you to avoid overspending on food and drink when you're away from home. This last point is an excellent segue to our next topic on cutting your costs. Any spending category, when you are able to cut costs, will help you stay on track and avoid accumulating debt. We have just discussed needs versus wants. Often just taking the time to think about a purchase will help you make better decisions. But here are some helpful tips to use when making your necessary purchases. Separate your needs from your wants by being honest with yourself about whether you truly need a purchase. Shop off-brand. You can often find similar products for lower cost minus the name brand attached to it. Look for products that are multi-purpose to avoid having to buy more items. Let's now understand the concept of interest. Interest is the cost of borrowing and is charged when you use money from resources that are not your own, such as loans, credit cards, or mortgages. Products will often have multiple interest rates depending on the purchase type. Interest rates can be fixed, meaning they remain the same, or variable, meaning they can fluctuate up or down. When you are charged interest, you are paying more for an item than you would have if you had purchased the item with cash or in full. Whenever possible, avoid using credit to make purchases or look for interest-free options.
A bond is a type of investment that represents a loan made by an investor to a borrower, typically a government or a corporation. When you buy a bond, you are essentially lending your money to the borrower, who promises to pay you back with interest over a set period of time. There are many different types of bonds, but the two most common are government bonds and corporate bonds. Government bonds are issued by national governments to fund their operations, while corporate bonds are issued by the companies to finance their growth or expansions. Other types of bonds include municipal bonds, which are issued by local governments, and convertible bonds, which can be converted into shares of stock. Bonds have a set maturity date, which is the date on which the borrower must repay the investor the face value of the bond. In the meantime, the borrower pays the investor interest payments at regular intervals, usually quarterly or semi-annually. The interest rate on a bond is typically fixed, but can also be variable depending on the type of bond. Bonds are rated by credit rating agencies such as Moody's and Standard & Poor's, based on the creditworthiness of the borrower. This rating reflects the likelihood that the borrower will default on the bond. Bonds with a higher credit rating are considered safer investments and typically offer lower interest rates, while bonds with lower credit ratings offer higher interest rates but are considered riskier investments. One of the main advantages of bond is their relatively low risk compared to other types of investment such as stocks. This makes them a popular choice for investors who are looking for a steady stream of income and want to protect their principal investment. Bonds also offer predictable returns, which can be beneficial for investors who are planning for retirement or other long-term goals. However, there are also some disadvantages to investing in bonds. One of the main drawbacks is that the returns on bonds are typically lower than other types of investments, such as stocks or real estate. Bonds are also subject to interest rate risk, which means that if interest rate rises, the value of existing bonds will decline. Additionally, Bonds with lower credit ratings carry a higher risk of default, which can result in a total loss of the investor's principal amount. Let's dive deeper into the different types of bonds. Government bonds can be further categorized into treasury books, treasury notes, and treasury bills. Treasury bonds have a maturity of more than 10 years. Treasury notes have a maturity of 2 to 10 years, and treasury bills have a maturity of less than 1 year. These bonds are considered to be among the safest investments because they are backed by the full faith and credit of the government. Corporate bonds, on the other hand, are issued by companies to raise capital. These bonds typically offer higher interest rates than government bonds but are considered riskier investments because they are dependent on the financial health of the issuing company. In addition, corporate bonds can be further divided into investment grade and high yield or junk bonds depending on their credit rating. Bonds are traded in the bond market, which is similar to the stock market. The bond market is an over-the-counter market, which means that bonds are traded through a network of dealers rather than on an exchange. Bonds can also be bought and sold through online brokerage accounts. One important concept to understand when it comes to bond is yield. Yield is the return on investment that an investor can expect to receive from a bond. The yield on a bond is determined by the interest rate of the bond and the price that the bond is currently trading at in the market. As bond prices go up, yields go down and vice versa. There are several ways to invest in bonds, including buying individual bonds, bond mutual funds, and bond exchange traded funds (ETFs). When investing in individual bonds, it's important to research the creditworthiness of the issuer and the bond's credit rating. Bond mutual funds and ETFs, on the other hand, provide diversification by investing in portfolio of bonds. As mentioned earlier, bonds are subject to interest rate risk. This means that changes in interest rates can have a significant impact on the value of bonds. When interest rates rise, the value of existing bonds will decline because newer bonds with higher interest rates become more attractive to investors. Conversely, when interest rates fall, the value of existing bonds will increase because they are now more attractive than newer bonds with lower interest rates. Bonds play a crucial role in a diversified investment portfolio. They provide stability and income to investors while also reducing the overall risk of the portfolio. When stocks are performing poorly, bonds tend to perform well and vice versa. This is because stocks and bonds are affected differently by economic and market conditions. Adding bonds to a portfolio can help smooth out the ups and downs of the stock market and provide a more consistent return. There are several factors that can affect the price of bonds. In addition to changes in interest rates, the creditworthiness of the issuer, the maturity date, and the supply and demand in the bond market can all impact bond prices. Economic conditions such as inflation and unemployment can also affect the value of bonds. Inflation is an important consideration when investing in bonds. Inflation refers to the rate at which prices for goods and services are increasing. When inflation is high, the purchasing power of the money invested in bonds decreases over time. This can be a concern for investors who rely on bonds for income. To protect against the effects of inflation, investors can consider inflation-protected bonds, which are designed to keep pace with inflation. Another important consideration when investing in bond is the tax implications. The interest income from bond is subject to federal and state income taxes. However, there are certain types of bonds that are tax exempt, such as municipal bonds issued by the state and local governments. In addition, there are tax advantaged accounts such as IRAs and 401ks that can provide tax benefits for investing in bonds. Investing in bonds requires staying informed about the latest news and trends in the bond market. Changes in interest rates, credit ratings, and economic conditions can all impact the value of bonds. Investors should keep a close eye on the performance of their bond investments and adjust their strategy as needed. Global events can also have a significant impact on the bond market. For example, political instability, natural disasters, and pandemics can all affect the performance of bonds. The COVID-19 pandemic is a recent example of a global event that had a significant impact on the bond market. The pandemic led to a decrease in interest rates, which in turn caused the value of many bonds to increase. Investors who want to invest in bonds but don't have the expertise to pick individual bonds can consider bond funds. Bond funds invest in a portfolio of bonds and provide diversification for investors. However, bond funds also come with their own risks, including the risk of default by the bond issuer and the risk of interest rate fluctuations. Investors should carefully consider the risks and benefits of bond funds before investing. Bonds play a particularly important role in retirement planning. As investors near retirement, they typically shift their investment portfolio from stocks to bonds because bonds provide a more stable source of income. However, investing in bonds also carries the risk of inflation, which can erode the value of the investment over time. To address this risk, retirees may want to consider a mix of bonds and inflation protected securities. One of the most significant factors that can impact bond prices is changes in interest rates. When interest rates rise, the value of existing bond decreases because investors can earn a higher yield from new bonds issued at the higher interest rate. Conversely, when interest rate decreases, the value of the existing bond increases because investors can earn a higher yield from the existing bonds than from new bonds issued at lower interest rate. This inverse relationship between interest rates and bond prices is known as interest rate risk. Credit ratings are another important factor to consider when investing in bonds. Credit ratings provide an assessment of the creditworthiness of the bond issuer based on factors such as its financial stability, debt load, and ability to repay the bond. Bonds issued by companies or governments with high credit ratings are generally considered to be less risky than those with lower credit ratings. However, bonds with high credit ratings also tend to offer lower yield than those with lower credit ratings. Bond duration is a measure of the sensitivity of bond prices to changes in interest rates. Bonds with longer durations are more sensitive to interest rate changes than those with shorter durations. This means that if interest rate rises, the value of a bond with a longer duration will decrease more than that of a bond with a shorter duration. Investors can manage interest rate risk by choosing bonds with durations that match their investment goals and risk tolerance. High yield bonds, also known as junk bonds, are bonds issued by companies with lower credit ratings. These bonds offer higher yield than investment grade bonds, but also come with higher risk of default. High yield bonds can be an attractive option for investors seeking higher returns, but they require careful consideration of the risks involved. Inflation is another factor that can impact bond prices. When inflation rises, the value of a bond's future cash flow decreases in today's dollars, which can cause the value of the bond to decline. To address the risk, investors can consider inflation protected securities such as Treasury Inflation Protected Securities TIPS, which offer protection against inflation. Diversification is a key strategy in bond investing. Investing in a range of bonds can help reduce the risk of a single bond defaulting or underperforming. Investors can diversify their bond portfolio by investing in bonds with different maturities, credit ratings, and sectors. Taxes can also impact the returns of bond investments. Bond interest is typically subject to federal and state income taxes, which can reduce the after-tax return on investment. To address the issue, investors can consider investing in tax-free municipal bonds, which are exempt from federal income taxes and may be exempt from state and local taxes. Finally, investors should regularly review their bond portfolio to ensure it continues to align with their investment goals and risk tolerance. Periodic review can help investors identify any changes in market conditions or personal circumstances that may require adjustments to the portfolio. It's also important to rebalance the portfolio periodically to maintain the desired allocation of assets. Bonds are a critical component of any well-diversified investment portfolio, providing stability, income, and diversification. Investors should carefully consider the risks and rewards of bond investing, including interest rate risk, credit risk, inflation risk, and tax considerations. By understanding these factors and implementing a well-diversified portfolio, investors can achieve their investment goals while managing risk. Regular portfolio review and adjustment can help ensure the portfolio remains aligned with the investor's goals and risk tolerance over time. Firstly, let's define what finance planning is. Finance planning involves creating a roadmap for your financial future. It's about assessing your current financial situation setting financial goals, and developing a plan to achieve those goals. The first step in finance planning is to assess your current financial situation. This involves taking a closer look at your income, expense, and debt. By understanding your current financial situation, you can determine areas where you can cut back on expenses or increase your income to help you achieve your financial goals. Once you have a clear picture of your current financial situation, the next step is to set financial goals. This could be anything from paying off debt, saving for a down payment on a house, or preparing for retirement. Your goals should be specific, measurable, attainable, relevant, and time bound. This is known as the SMART criteria. Now that you have established your financial goals, the next step is to develop a plan to achieve them. This involves creating a budget, which is essentially a plan for your income and expenses. By creating a budget, you can track your spending and ensure that you are putting money towards achieving your financial goals. Another important aspect of finance planning is to manage your debt. Debt can be a major roadblock to achieving your financial goals, so it's important to have a plan in place to pay off any outstanding debts. This could involve creating a debt repayment plan, consolidating your debts, or seeking the advice of a financial advisor. Investing is also an important aspect of finance planning. Investing can help you achieve your financial goals by allowing your money to grow over time. It's important to understand the different types of investment available, such as stocks, bonds, and mutual funds, and to seek the advice of a financial advisor before making any investments. Insurance is also an important aspect of financial planning. Insurance can help protect you and your family in the event of an unexpected event such as illness or disability. It's important to assess your insurance needs and to ensure that you have the right coverage in place. It's important to regularly review and update your finance plan. Your financial situation and goals may change over time, so it's important to ensure that your plan is still relevant and effective in helping you achieve your financial goals. A budget is a crucial tool for managing your finances and achieving your financial goals. It helps you track your income and expenses and ensures that you are putting your money towards your priorities. When creating a budget, start by listing all of your income sources, such as your salary or any side hustles. Then, list all of your expenses, including fixed expenses such as rent or mortgage payments, utilities and groceries, as well as the variable expenses such as entertainment or dining out. Once you have your income and expenses listed, subtract your expenses from your income to determine your disposable income. This is the amount of money you have left over each month to put towards your financial goals. Debt can be a major roadblock to achieving your financial goals, so it's important to have a plan in place to manage and pay off any outstanding debts. One strategy for managing debt is to create a debt repayment plan. Start by listing all your debts, including the balance, interest rate, and monthly payment. Then, prioritize your debt based on the interest rate. Focus on paying off the debt with the highest interest rate first. You may also consider consolidating your debts into one loan with a lower interest rate or seeking the advice of a financial advisor. Investing can be a powerful tool for achieving your financial goals by allowing your money to grow over time. There are many types of investments available, including stocks, bonds, mutual funds, and real estate. Before investing, it's important to do your research and seek the advice of a financial advisor. It's also important to understand your risk tolerance or your willingness to take on risk in pursuit of higher returns. Generally, younger investors can afford to take on more risk since they have more time to recover from any losses, while older investors may want to focus on more conservative investments. Insurance is an important aspect of finance planning as it helps protect you and your family in the event of an unexpected event such as illness, disability, or death. It's important to assess your insurance needs and ensure that you have the right coverage in place. Common types of insurance include health insurance, life insurance, disability insurance, and long-term care insurance. Again, it's important to seek the advice of a financial advisor when selecting insurance policies to ensure that you have the right coverage for your needs. Finally, it's important to regularly review and update your finance plan. Your financial situation and goals may change over time, so it's important to ensure that your plan is still relevant and effective in helping you achieve your financial goals. Set aside time each year to review your plan. make any necessary updates, and adjust your strategies as needed. Finance planning can be overwhelming, especially if you are just starting out. However, it's important to remember that small steps can lead to big progress. Here are some additional tips. Here are some additional tips to help you get started. Start tracking your expenses. Understanding where your money is going is the first step towards creating a budget and making informed financial decisions. Start saving. Even if it's just a small amount, starting a saving habit can help you build your emergency fund and work towards your long-term financial goals. Automating your savings, bill payments, and investments can help you stay on track and avoid missed payments or late fees. Educate yourself. There are free resources available online, such as financial blogs, podcasts, and courses that can help you improve your financial literacy and make informed decisions. Remember, finance planning is a lifelong process. By committing to taking small steps towards your financial goals every day, you can achieve financial security and peace of mind. Another important aspect of finance planning is creating an emergency fund. An emergency fund is a savings account set aside for unexpected expenses such as a medical emergency or a job loss. Financial experts recommend having 3 to 6 months worth of living expenses saved in an emergency fund. This can help you avoid taking on debt or dipping into your long-term savings in the event of an unexpected expense. When it comes to investing, it's important to have a diversified portfolio. This means investing in a mix of assets such as stocks, bonds, and real estate to help spread out your risk. A financial advisor can help you create a personalized investment plan based on your risk tolerance and financial goals. It is also important to have a plan for retirement. This includes setting aside money in retirement accounts such as 401k or IRA and regular reviewing and adjusting your investment strategy as you approach retirement age. A financial advisor can help you create a retirement plan that takes into account your retirement goals and expected income sources. Finally, it's important to be mindful of your spending habits. This includes avoiding impulse purchases, using credit cards responsibly, and regularly reviewing your expenses to look for areas where you can cut back. By being mindful of your spending habits, you can put more money towards your financial goals and achieve financial security more quickly. In addition to the tips already mentioned, here are a few more strategies that can help you achieve your finance planning goals. Negotiable bills. Many service providers such as cable, internet, and phone companies are willing to negotiate lower rates for their customers. Don't be afraid to ask for a better deal or shop around for better rates. Using a budgeting app. There are many free budgeting apps available that can help you track your expense, set spending limits, and save money. Take advantage of employer benefits. If your employer offers benefits such as a 401k match or a flexible spending account (FSA), be sure to take advantage of them. These benefits can help you save money on taxes and boost your retirement savings. Consider a side hustle. If you are looking to boost your income, consider starting a side hustle. This could be anything from freelance writing to selling goods online. Just be sure to factor in the additional income when creating your budget and financial plan. It's also important to consider your debt management strategy when creating your finance plan. This includes assessing your current debt levels, prioritizing high interest debt, and developing a plan to pay off your debt as quickly as possible. One popular strategy is the debt snowball method, where you pay off your smallest debt first and work your way up to larger debts. Another strategy is the debt avalanche method, where you focus on paying on debts with the higher interest rate first. When it comes to insurance, it's important to have the right coverage in place to protect yourself and your assets. This includes health insurance, life insurance, disability insurance, and homeowners or renters insurance. Be sure to review your insurance coverage regularly and adjust it as needed based on changes in your life or financial situation. Ultimately, finance planning is about taking control of your financial future and making informed decisions to help you achieve your goals. By following these steps and seeking the advice of a financial advisor, you can create a plan that is tailored to your unique needs and circumstances. Remember, finance planning is a lifelong process, but with commitment and dedication, you can achieve financial security and peace of mind. One final aspect of finance planning to consider is estate planning. This involves creating a plan for what will happen to your assets and property after you pass away. This includes creating a will, setting up trusts, and designating beneficiaries for your retirement accounts and life insurance policies. Estate planning can help ensure that your wishes are carried out after you have gone and can help prevent family conflicts or legal issues. It's important to remember that finance planning is not a one-time event, but rather an ongoing process. As your life circumstances change, your financial plan may need to be adjusted to reflect those changes. It's important to review your plan regularly and make adjustments as needed. One common mistake that people make with finance planning is trying to go it alone. Seeking the advice of a financial advisor can help you avoid common mistakes, stay on track with your goals, and make informed decisions about your finances. A financial advisor can help you create a personalized plan that takes into account your unique needs and circumstances. In conclusion, finance planning is a comprehensive process that involves assessing your current financial situation, setting specific and attainable financial goals, developing a plan to achieve those goals, managing your debt, investing, ensuring that you have the right insurance coverage in place, regularly reviewing and updating your plan, and being mindful of your spending habits. By following these steps and seeking the advice of a financial advisor, you can take control of your finances and achieve financial security and stability. Remember, finance planning is a lifelong process, but by committing to taking small steps towards your financial goals every day, you can achieve financial success and peace of mind. Have you ever received a paycheck and wondered why so much of it goes towards taxes? That's because a portion of your income is deducted as income tax. The government uses this tax revenue to fund public services like healthcare, education, and infrastructure development. Income tax is one of the main sources of revenue for the government. In fact, it's a crucial part of a country's economy. Without income tax, the government would not have the necessary funds to provide public services and support the country's growth and development. When it comes to income tax, understanding how it works is crucial. If you are an employee, your employer will deduct income tax from your paycheck and send it to the government on your behalf. However, if you are self-employed or have additional sources of income, you will need to file an income tax return and pay any taxes owed directly to the government. Filing an income tax return can be daunting, especially if you are doing it for the first time. But don't worry, there are resources available to help you navigate the process. From tax professionals to online resources, there are many tools available to help you file your income tax return accurately and on time. While income tax can seem like a burden, there is a silver lining. If you have paid more income tax than you owe, you'll receive a tax refund. That's right, the government will give you back the extra money you paid in taxes. It's essential to understand how income tax works to take advantage of all the benefits it offers. For example, there are tax deductions and credits available for things like charitable donations, education expenses, and home ownership. By taking advantage of these deductions and credits, you can reduce your tax bill and keep more of your hard-earned money. As technology has evolved, filing taxes has become easier than ever. Online tax filing services have made it possible for people to file their taxes from the comfort of their own homes. These services are convenient, secure, and can save you a lot of time and hassle. It's important to note that income tax laws can change from year to year. That's why it's crucial to stay up to date on the latest tax laws and regulations. This will ensure that you are filing your taxes correctly and taking advantage of all the deductions and credits available to you. Finally, it's important to understand that failing to pay income tax or filing your tax incorrectly can result in penalties and interest charges. It's essential to take income tax seriously and ensure that you are complying with all tax laws and regulations to avoid any legal consequences. If you are unsure about how to file your taxes or have any question about income tax, it's always best to consult with a tax professional. They can provide guidance on the best course of action and ensure that you are filing your taxes correctly. So don't let income tax stress you out. With a little bit of knowledge and the right resources, you can navigate the process with ease and ensure that you are taking advantage of all the benefits it offers. One of the best ways to manage income tax is to keep track of your finances throughout the year. By keeping detailed records of your own income and expenses, you'll be better prepared when it's time to file your taxes. This can also help you identify potential deductions and credits that can reduce your tax bill. Charitable donations are a great way to give back to your community and also reduce your tax bill. When you donate to a registered charity, you can claim a tax credit on your income tax return. This can be a win-win situation for both you and the charity. If you have children, education expenses can also provide tax benefits. For example, you can claim a tax credit for the cost of your child educations, including tuition fees, textbooks, and transportation. This can help offset the cost of education and also reduce your tax bill. Home ownership is another way to take advantage of income tax benefits. When you own a home, you can claim deductions on your income tax return for things like mortgage interest, property taxes, and home repairs. This can help reduce your tax bill and also make home ownership more affordable. To get an idea of how much income tax you'll owe, you can use a tax calculator. These online tools can help you estimate your tax bill based on your income, deductions, and credits. This can help you plan ahead and avoid any surprises come tax time. Once you have filed your income tax return, it's important to review it carefully. Make sure that all your information is accurate and that you have claimed all the deductions and credits that you are entitled to. This can help you avoid any errors or omissions that could lead to penalties or interest charges. Filing income tax may seem like a daunting task, but an essential part of being a responsible citizen. By understanding how it works and taking advantage of all the benefits it offers, you can ensure that you are complying with all tax laws and regulations while also keeping more of your hard-earned money. So take control of your income tax and start planning ahead today. With the right knowledge and resources, you can navigate the process with ease and ensure that you are making the most of all the benefits it offers. The COVID-19 pandemic has had a significant impact on the economy and the way we work. If you're working from home, you may be eligible for some tax deductions. This can include expenses related to your home office, such as a portion of your rent, utilities, and internet bills. It's important to keep detailed records of these expenses and speak with a tax professional to see if you qualify for these deductions. Investing in stocks and other investments can also provide tax benefits. For example, if you hold a stock for more than a year before selling it, you may be qualified for a lower tax rate on any gains. This can help you maximize your returns while also reducing your tax bill. If you travel for work, you may also be eligible for tax deductions. This can include expenses related to transportation, lodging, and meals. It's important to keep detailed records of these expenses and speak with a tax professional to see if you qualify for these deductions. Starting a small business can be an exciting and rewarding venture, but it also comes up with tax responsibilities. As a business owner, you'll need to keep detailed records of your income and expenses, and you may be eligible for various tax deductions and credits. It's important to speak with a tax professional and ensure that you are complying with all tax and regulations. If you volunteer for a non-profit organization, you may also be eligible for tax deductions. This can include expenses related to transportation and any other costs incurred while volunteering. It's important to keep detailed records of these expenses and speak with a tax professional to see if you qualify for these deductions. And finally, if you have paid too much income tax throughout the year, you may be eligible for a tax refund. This can be a great way to get some extra cash and put it towards your financial goals. It's important to review your tax return carefully and ensure that you have claimed all the deductions and credits that you are entitled to. Income tax can seem overwhelming, but by staying informed and taking advantage of all the benefits it offers, you can ensure that you are complying with all tax laws and regulations while also keeping more of your hard-earned money. So start planning ahead today and take control of your income tax. And if you have any questions or concerns about income tax, it's always a good idea to speak with a tax professional. They can help you navigate the process, answer any questions you may have, and ensure that you are complying with all tax laws and regulation. It's important to review your paycheck regularly and ensure that the correct amount of income tax is being deducted. If you find that you are having too much or too little income tax withheld, you can make adjustments by completing a new W-4 form with your employer. There are also many online sources available to help you stay informed about income tax. The IRS website offers a wealth of information and tools, including tax calculators, FAQs, and downloadable forms. You can also find many reputable financial websites and blogs that provide tips and insight on income tax and other financial topics. And if you really want to dive deep into income tax, you can attend a tax seminar or workshop. These events are often hosted by tax professionals or financial experts and provide a great opportunity to learn more about income tax and other financial topics. Income tax may seem like a complex and daunting topic, but with the right knowledge and resources, you can navigate the process with ease and ensure that you are complying with all tax laws and regulations. So take control of your income tax today and start planning ahead for a more financially secure future. Another way to reduce your income tax bill is by making charitable donations. Donations to qualified charitable organizations can be tax deductible, meaning you can deduct the amount of your donation from your taxable income. This can lower your overall tax bill and support a cause you believe in. Contributing to a retirement plan such as a 401k or IRA can also provide tax benefits. These plans offer tax deferred growth, meaning you won't pay taxes on your investment gains until you withdraw the money in retirement. Additionally, contribution to these plans may be tax deductible, which can lower your current year tax bill. And if you do not receive a tax refund, it's important to use it wisely. Consider using your refund to pay off debt, building an emergency fund, or invest in your future. By making smart financial decisions with your tax refund, you can set yourself up for a more financially secure future. And if you're looking to take your financial planning to the next level, consider meeting with a financial planner. A financial planner can help you create a comprehensive financial plan, including retirement planning, investment management, and tax planning. They can also help you stay on track towards your financial goals and make adjustments as your circumstances change. Income tax is just one piece of the puzzle when it comes to your overall financial picture. By staying informed and taking advantage of all the tax benefits available to you, you can maximize your savings and set yourself up for a more financially secure future. So take control of your income tax and your finances today and start building the life you want. It's important to remember that income tax laws and regulations can change from year to year. Keeping up with things can be challenging, but it's essential if you want to make the most of your tax benefits and avoid any potential penalties. One way to stay informed about tax changes is regularly review the IRS website or consult with a tax professional. Additionally, many news outlets and financial websites provide coverage of tax law changes and their potential impact on taxpayers. When it comes time to file your tax return, be sure to review your forms carefully before submitting them. Errors or omissions on your tax return can result in penalties or even an audit. So take the time to review your form and ensure that all information is accurate and complete. If you do receive a tax notice, an audit request from the IRS, don't panic. These notices are often routine and can be easily resolved by providing the requested information or documentation. If you are unsure how to respond, consider consulting with a tax professional for guidance. And finally, remember that filing your income tax return can be a cause for celebrations by taking control of your finances and meeting your tax obligations. You are setting yourself up for a more financially secure future, so celebrate your accomplishments and start planning for the year ahead. Income tax may not be the most exciting topic, but it's an essential part of your financial picture. By staying informed, planning ahead, and taking advantage of all the tax benefits available to you, you can minimize your tax bill and set yourself up for a more financially secure future. So take control of your income tax today and start building the life you want. Do like and subscribe to our channel to know more about finance. Thank you for watching.